Good afternoon, everyone. I'm Jeremy Horan. I'm the newish VP of Government Affairs for ACORE. Here to introduce the next panel so we can get moving. We've had some great conversations so far, and I'm excited to continue with our next panel, which is the growing transferability marketplace. Our panelists will reflect on the growth of the transferability marketplace and examine developing trends in pricing and deal structures. They'll also identify the market signals and activities needed to incentivize new entrants to engage in the sector. Our moderator for this panel is going to be Rob Wilson, audit partner with KPMG. So with that, welcome Rob and panelists.
Oh. Bright lights.
Yeah.
I like the warm-up music.
Huh?
The warm-up music's good.
Mic.
Oh, that mic.
All right, I think we'll jump right into this. I'll start off, let me just quickly introduce myself and my wonderful panelists here. My name is Rob Wilson. I'm a partner at KPMG. I'm part of our renewable leadership team, working with clients throughout the industry, all types of clients within the renewable and sustainability space. And I am lucky enough to moderate a great panel here with some great panelists, and hopefully you all enjoy it. And certainly feel free to funnel through questions, and I'll try to fill them as we're going through, and I'll throw some curveballs at these guys. So let me start off introducing everyone. To my immediate left here, and I am going to read because we have some pretty impressive resumes here. We have Eric Barr from the Business Development Office at U.S. Bank. Eric's been at U.S. Bank Corp Community Development Corporation since 2012, and he's currently a business development officer working in renewable energy investment tax credits. He is a CPA, so I like him already, and he specializes in investments that generate investment tax credits within the renewable energy space. To Eric's left, we have Udit Goyal. Udit leads the project finance team at Ørsted, focusing across technologies including onshore wind, solar, storage, and offshore wind. And he has over 12 years of experience in development, construction operations, and financing of utility-scale renewable energy projects. To his left, we have Alfred Johnson. Alfred is the CEO and co-founder of Crux, which is an ecosystem for developers, tax credit buyers, and financial institutions to transact and manage transferable tax credits. He previously served as Deputy Chief of Staff to Secretary Janet Yellen at the Treasury Department and held senior political appointments in the Obama and Biden administrations, working on technology, financial management, and financial regulatory issues. And then last but not least, we have Inés Serrao. She is a managing director and the head of renewables at CIBC. And she's an industry project and working in the industry project finance platform. And she also supports the development of renewables in the US. And she previously worked in the project finance in the Silicon Valley Bank and has worked at ING and BBVA. So we have some really, really qualified professionals here to talk about the growing transferability marketplace. And Alfred, I'm going to tee you up. I'm going to come to you first. But when I think about the Inflation Reduction Act, we heard David Crane talk earlier about just the aspect of the act that his group oversees, and he made mention that that excludes everything that's tax credit related. So we're talking about a very big piece of legislature. A bunch of companies have certainly benefited from the Inflation Reduction Act. I was hoping you could just kind of level set us. Let's take a step back, talk about some of the things that are key in terms of the IRA, but also what you're seeing in the marketplace from your perspective.
Sure, thanks. So I think you have to start with the sense of scale around this stuff. And I think, frankly, we, the collective we, got used to these very large pieces of legislation during the COVID era. There were multiple trillion-dollar packages that were passed in pretty quick succession. It looked like Build Back Better was going to pass, then it very clearly failed and looked like it was not going to pass. And then in August of 2022, voila, it passed. And it was so much smaller than the earlier versions of the law that people were kind of disappointed by the $370 billion law. Turns out that the CBO probably underscored what the size of that is going to be. Private sector estimates on this from Evercore, Goldman Sachs have it as something like $1 trillion of total government subsidy that is going to go into the space, catalyzing something like $3 trillion worth of investment. So just unbelievably large, catalytic, new piece of legislation. 2/3 of it is tax credits. So there is a material amount of money that is going to the programs that David oversees, but the most of the subsidy is coming through the tax code. And there are 12 different kinds of federal credits that are now made to be transferable for the first time, because what the law effectively did was supercharge the amount of supply that is going to be in the system. And Congress looked at that amount of supply and the existing tax equity market. And the concept was to create this new notion of transferability, where now the credits can be directly sold. That market started to move in the summer of this past year. It became legal to transact at the beginning of 23. Substantially no transactions happened for the first half of the year in 23. The government put out very constructive guidance, which led the market to start to form. Some big deals were announced. There was one between Bank of America and Invenergy, a $580 million PTC transaction that got a lot of attention, in part because the players there were the sorts that had previously done tax equity exclusively and were not anticipated to be in the transfer market as early as they were. And then the market really accelerated in the back half of last year. We did a market survey where we found $3.5 billion of specific 23 transactions and used that to extrapolate a market size on transfers for $7 to $9 billion. The 23 market persisted into 24. People are frankly still transacting on 23s, and we're seeing that pricing is healthy across the board. So it is generally correlated with size, and I know we're going to get into this in greater depth, generally correlated with size, but overwhelmingly the market is forming in the high 80s to the mid to high 90s in a way that is very constructive, and we're seeing a lot of new buyers participate in the market in a way that I think is going to lead to many more investments going into the space, but there's a lot more work to do to cover the scale that needs to go through the market.
So you foreshadowed a few topics that we're going to come back on, but before we go down that path, I just wanted to ask if there's, I think Alfred framed that up nicely. A two-part question for you. One, is there anything else that you would add on top of that in terms of the IRA and the transferability of credits that you think should be pointed out? But secondly, what does that mean for your company and your organization? How do you look at it, and how does that compare and contrast to what you think other companies may be looking at from a benefit standpoint?
Yeah. Let me start with the second question here, because that was a very helpful summary, and I'll just sort of like really you provided a very high level macro view, and let me try to just like bring it down to how we started thinking about it when we started to understand. Like last year, a lot of this conference was, when we were talking about transferability, the first question would pop up is like, oh, what do I do about depreciation? Like I'm losing a lot of value in my model. So we just started to like think about like how do we sort of preserve the value in our models, looking at this new transferability sort of landscape, right? So depreciation was a big question. The second big point obviously was like, well, what am I going to get for it? Like it was never a question. Your PTC was valued at $1 in the models, and you never had to think about it twice. But then now there's this whole open, the impact, whether you have a low 80 cents in the model or you have like somewhere in mid to high 90s is quite substantial. So like, what do you assume? There was always this question about ITC versus PTC, and we sort of had an understanding most of the market wanted to do the PTCs because of the spikiness of the ITC profile, barring a few investors, but like that just got turned on its head. Everybody now is like, well, give me ITCs because I can transfer them out, right? So it just sort of led to a lot of new things for us to think about, between the adders and energy community, domestic content, just sort of holistically looking at like, what does our pipeline look like? Where do we see value in our models, right? So that was the first thing we started like really looking at in depth. Once we sort of had a handle on like, okay, how many credits are we going to have, whether it's transferability or tax equity, et cetera, then we were thinking about like, okay, what do I do with these? Like, do I go to a broker? Like, who do I find? Who's going to buy these from me? Like, do I just call up, my origination team who has been dealing with off-takers for a very long time, and see if they want to like, pawn off some PTCs and ITCs for us? Do we go to the big banks, or do we rely on innovation in the market like Crux? And platforms that are popping up. So the last thing we spent a lot of time on was like, do I understand this from a tax standpoint? Do I understand the tax risk? Do I understand insurance in this whole where this all fits about? So we took sort of this very macro level, sort of this big piece of legislation, a lot of money at play, to like really try and figure out what does this mean for our sort of our own portfolio. And I think it probably resonates with a lot of folks who are probably thinking about it the same way. So I don't think we were doing anything that was like groundbreaking, but hopefully this sort of like resonates with how a lot of people sort of were like on the ground thinking about this.
Good. Eric and Nise, I want to pull you into the conversation as well. So there are different types of products, different deal structures, if you think about it that way. And Eric, I'll start with you. What different types of deal structures are you seeing in the marketplace? Specifically with both of you from a banking and a lending perspective, can you give the audience a little bit of a feel of what you're seeing?
Yeah, certainly. So, one of the things that we're very mindful of in a post-transferability world is that we essentially have two customers now. We have our developer owners, but we also have our tax credit buyers. One of the things that our owners are constantly telling us is that they want a tax equity partnership. They want a commitment for the full amount of tax credits at or around NTP. They want a monetized depreciation step-ups, and they want sort of an execution that is reliable and predictable. And so that's something that's important to us to continue to do. So when we give Udit a tax credit commitment, he knows his economics day one. He doesn't really have to worry about what price the transfer market is going to be at 9 months, 6 months from now. So we're focused on closing traditional partnerships with quality sponsors. After we get to the closing table, only then are we taking our book of closed transactions and presenting them to the transfer market. These are people that are bank clients, or other folks that are working hard at their businesses that want to simply pay a little bit less in taxes, and they value an established platform, an established underwriting diligence platform, and so we come in and we transfer our credits out of those partnerships. I won't say that it's exactly simple, but a standard transfer agreement out of a partnership is between 20 and 40 pages. That's much shorter in nature, and so that's what we're focused on. Is sort of, I think people are calling it a hybrid approach today, and I think that's most of the market. Not every project is ripe for a typical tax equity partnership. So some people are simply transferring out without doing a tax equity partnership, but that's a very small portion of our business for a subset of projects that generally we couldn't do a tax equity partnership on anyway.
Nise, anything to add from your perspective?
Sure. Maybe I'll summarize how we're seeing the market, and we've talked a little bit about this. The previous panel also talked a little bit about this, but I would maybe split it into traditional tax equity on one hand, that's being less common. Then you go into hybrid structures where you have someone backstopping the full amount of tax equity investment and then potentially selling in the back. That allows for the step up, that allows for depreciation to be considered. You also have some entities providing a commitment that is not the full amount of the commitment, so they take a portion of this and they, with the sponsors, together syndicate the transfer credits in the back. And then at the other side of the spectrum, you have direct transfers, where the issue is, can the sponsor directly take the step up and the depreciation? And if not, they're just leaving that on the table. This is an evolving market, as everybody said, so we're very curious to see where this is all going to end up. And then the other side of the structures that I think differentiates a little bit from deal to deal is, does the sponsor have credit worthiness where they backstop the indemnity obligations? And I know the previous panel talked a little bit about this too. Or do they need to get insurance in the market for this risk? From a lending perspective, banks are getting more comfortable, including CIBC, lending to uncommitted tax equity or transferability at a lower leverage. We want to support our sponsors, and the depth of the market, basically, and the market that's emerging is allowing banks to get comfortable with it at a lower advance rate. And then that gives the sponsor more time to find a tax equity partner or a transfer partner. And as soon as they do that, leverage can go up based on that new commitment that the sponsor gets. Maybe I'll stop here for now.
No, that's good. I do want to double click on one item that you said. So we talked a little bit about indemnities, guarantees. One of the things that I think about early on with the tax equity structure was all of the diligence that kind of went into that. What are you all seeing? This is really a question for anyone. From a diligence perspective, are we seeing a ramp up in the diligence that's done for these transfer agreements, or what are you currently seeing?
Sure, I can take that one. Our approach as a tax equity investor through partnerships is very right for folks that are diligence heavy. We see some sponsors want, or some buyers want a lot of diligence, some want less. So there's a spectrum on what buyers are comfortable with. We can offer them as much or as little as they're looking for. If there's one thing that I think about with transferability that everybody here should really understand is that the buyers of these credits are looking for a risk-free transaction. And you see that through insurance, through the indemnities that they're asking for, and often through the diligence that they're requesting.
Got it. Thank you.
Rob, just to add to it, I would observe that different credits are different, and different buyers have different profiles in terms of the amount of risk that they would like to take on. We're actually about to produce another white paper about the diligence that people are doing in the market, where we polled 45 different advisory firms that are doing diligence on behalf of clients covering more than 500 transactions, and asked them how much they're doing on each of the items that people typically look at. And we asked them to say whether things are carefully reviewed, whether they are checked for completeness, whether they're typically not reviewed, the level of negotiation that goes into that. And what we're finding there is that the diligence that is done just on the transfer is materially less than on a tax equity investment where a position is taken in the asset. There's still a lot of diligence. Often buyers are looking to the insurance policy, but they're still looking at the underlying information just with a lot less depth than they previously would. And often products like the US Bank product, where US Bank is guaranteeing the credit, is something that provides for even more assurance to the buyer that is not really looking to go to depth on the diligence.
Got it. Udi,
Yeah.
Oh, go ahead.
Yeah, I want to add something to this. There's something as sponsors, we're trying to not think too much about the diligence aspect of this, right? Like, yes, it is, and I'll say it is obviously quite painful to go through, the tax equity documentation process and, the reams of papers that follow, and it's great to hear that there are transfer agreements that are like 20, 40 pages to get stuff done. But I think as sponsors, we're trying to think about it that, over the last decade or so, we've obviously become a very mainstream industry. Like whether we have, if you think about the capital stack, folks coming in for equity or debt or now for transferability, they're all coming in because over the past 20 years, we've shown the assets are doing what they're supposed to do. This is a predictable, reliable investment to make. So, cutting corners on diligence is probably not something we want to do in the long run. We want to continue to everybody here wants this market to go from 20-odd billion to 50-odd billion and more, but the assets need to do what they're supposed to do. Otherwise, sort of the efficiencies of the market, any tools, any sort of, brokerage, it's just not going to get us there if the assets aren't doing what they're supposed to do. So I think we feel very strongly that as sponsors, this is really something that we have to be focused on, that just because there's slightly less diligence effort, that doesn't absolve us of our responsibility and our sort of work to ensure we're doing the right things.
Right. And I do want to talk about the assets that kind of underpin everything that we're talking about a little bit later, but I do want to stay with you. I mean, we are here at the Finance Forum, right? And we are clearly talking about tax credits now. We had the panel on tax equity previously. What are the types of things that you weigh from a financing decision perspective? Like, what are the things that you digest or what other companies in the room should think about when they're making their financing decisions?
Yeah. I think we come at it from a slightly different lens because we tend to be a big balance sheet shop, so that sort of affords you the benefit of not having to line up your NTPs with your construction debt with your tax equity, which obviously is a lot of work. I think the challenge that we face is just sort of on scale. Like we have a very large offshore portfolio. An average project, couple hundred megawatts. You're looking at raising capital to a few $100 million on each project, right? Like we have about 1.8 gigawatts of offshore wind that's supposed to come online between 26 and 27, and those numbers are astronomical. So I think the way we are thinking about a lot of this is just sort of from the depth in the market and the capacity in the market standpoint. On a lot of our onshore portfolio, we are sort of, we've worked through and we have understood how to sort of preserve the most value in the model. So I think everybody will look at it a little bit differently. But from our standpoint, what's key is execution certainty. We tend to not sort of dwell on finding the last penny as long as we know there's a strong counterparty we can execute a deal with. And then, just sort of lining up how one particular investment is going to fit into our portfolio broadly is sort of like the two things we tend to think about. But I'm sure it's very different if you're, sort of a develop and flip sort of a model, or if, you want to bring in equity partners at NTP or during operations, et cetera. So I'm sure people have to think about it slightly differently.
Anyone else have anything to add on that?
I mean, obviously, I'm glad Udit mentioned how important due diligence is and that sponsors do things right. That's very important from a finance perspective, and we keep a lot of focus on it. That the assets do what they're supposed to do is also very important, and that's from a lending perspective as well as from an investor perspective. We can talk about the types of assets, types of risks, and how different investors have different pain points and focus points. I think you can get appetite for across a different range of risk profiles, but the experience of the sponsor and the track record of getting projects to be complete and to be operational is very important. Depending on ITC or PTC, even with ITC, you still have recapture risk, so that's very important to keep in mind as well. And then just the type of asset and how merchant it is, et cetera. I know it's less important in the transferability in the tax equity world, but still important, and banks and investors still diligence that on the other side.
Okay. Alfred, this question is specifically for you, so I'll read it out loud for the audience. Does Crux plan on building software to facilitate the diligence process rather than just focusing on being a discovery mechanism for buyers and sellers? Any thoughts on that?
Great question. So, and I promise I didn't write it. So Crux, what is Crux? Crux is really two things. One is the marketplace, the liquidity layer where buyers, sellers, and advisors can find each other and transact. We now have $10+ billion worth of credits that are listed on the platform. We've raised about $27 million, including from great companies like Ørsted, in order to build the central ecosystem where more people can find each other. Because one of the things that we find is that matching supply and demand is actually hard, right? If you're looking for $75 million worth of demand for credits that have a certain set of characteristics on this timeline with this fiscal year end with this level of credit support, that actually becomes a difficult thing to do. So you need a lot of coverage of supply and demand. So we currently have that liquidity that's working. The other part of what we do is we're workflow software for the execution of the transaction. And these are simpler deals than tax equity, but not simple, hundreds of underlying documents, lots of stakeholders around the table, compliance obligations on the buy side. So we see opportunities to streamline that diligence process, and actually we're making a lot of efforts in structuring the underlying data and information such that buyers and sellers are having the right conversation about the right things. We're seeing where deals fall apart. We're helping people have the right conversations in the right order. And all of that will start to get instantiated in the product in a way that helps people go through the transaction in a simpler way. And we're starting to see some evidence that we're able to do that. We did a utility scale PTC actually sold by a utility to a Fortune 100 buyer, we closed that in 22 days. And it was obviously heavily represented. There were lots of lawyers around the table. There were lots of conversations. But we're getting to making these a bit more standardized and getting them through the pipe quicker.
Perfect. And before we pivot to a different topic, I do want to field this second question that just came in. And this is really for anyone. Can you comment on the variability of transferable credit insurance products that are available and any claims experience to date?
I can start. There's not any claims that, at least in our portfolio, and hopefully that's the case for others as well. So I'm not aware of many. I think this is just a broad comment in general, as insurance has obviously gotten significantly more difficult across the board, right? Like we've had the issues on the operational side, just sort of coverages getting more expensive, but specifically on tax insurance, I think the hybrid structures have, there was an intent that this would be the best of both worlds, but these hybrid structures in some scenarios, such as insurance, kind of bring out the worst of both worlds, because you have a tax equity investor, generally relatively risk averse, and you have a sort of like a lot of tax protections that you need to provide. And then, as Eric said, a lot of transferability players coming in are also looking for risk-free deals that folks aren't taking aggressive view on tax. So it's sort of putting a lot of stress on the sponsors to try and figure out the right insurance products and the cost that's associated with them to sort of bring these deals to fruition. I think we've generally been very close to a number of tax insurance providers, and I know Gary was moderating the panel before, so there are some details. I think we'll probably lose a lot of crowd on the minutia on this, but I think the punchline to me is that insurance has significantly gotten more difficult, and I think it's exacerbated by some of the tax risks that more people are having to think about on a day-to-day basis.
Alfred, let me come to you. I'm going to pivot to pricing a little bit. The panel before us, I think they hit on pricing at a high level, but what are you seeing in the marketplace? Certainly you've talked about studies and different data that you've kind of sifted your way through at Crux. What are you seeing in the marketplace in terms of pricing and different products from that standpoint?
Yeah, it's good to do pricing towards the end, because otherwise people leave because it's something that everybody is curious about. I want to make a point that has not yet been made but is relevant. We've mostly been talking here about utility scale, wind, solar, and storage, very large deals. There's a big component of the market that's smaller in those established categories. And there are new categories of credits that are increasingly coming to the market in size. And so speaking to the smaller deals, and in the data set that I have mentioned, the transactions that we saw were about 80% sub $50 million in terms of deal count. So a lot of stuff is going through the transfer market that is smaller than historically went through the tax equity market, and that makes a ton of sense. We see a correlation between pricing and size. So in the larger amounts of credits, we're seeing the lines flatten at something like 94 to 96 cents for production tax credits and 92 to 94 cents for investment tax credits. When you get to sub $10 million, the average pricing that we see on that is something closer to 89 cents. Interestingly, that kind of tax finance wasn't typically or historically available to a sub $10 million facility. So if they're getting an 89-cent purchase on the tax credits, that may be considerably better than anything that might have been available in the prior construct of the world. Last point I will make about new technologies. So there's obviously a range of them that are enabled by the IRA. The biggest new category that we are seeing is 45X, advanced manufacturing credits, which were not initially anticipated to come through the transfer market in the size that they are, which is a very interesting dynamic. So the 45X credits, after Treasury put out guidance on them in December, started to price closer to other production tax credits. And buyers, as mentioned on this panel and the prior one, really like production tax credits because it doesn't have the recapture risk associated with the basis and other aspects of ITCs. And so even those 45X production tax credits were starting to trade in the mid to high 90s. There was a very prominent deal that was announced between Pfizer And for solar that closed at 96 cents, they announced the price. And that dynamic has drawn even more 45X into the market. And what people are doing there is really a time value of money play, where if you can sell your 45X today at 93 to 96 cents versus wait for the government to pay you in direct pay whenever that happens, there's sort of the inherent cost of capital to getting that dollar in the future. And based on where pricing is, that's drawing people in. The interesting observation I've been starting to try to get my head around market size. So in the last panel, they talked about $50 billion market size. I actually think there's a lot of elasticity on the supply side of the market that's responsive to price. And with 45X being a very material piece of that, because again, if you have 45X pricing at 95 cents, people will sell the 45X in the transfer market. If it drifts to 85 cents, then people will hold and take direct pay on it. So you sort of have this like incremental supply in the market that will size up or down based on how much demand and supply can transact in the market.
Anis, do you have anything to add to that?
I agree with Alfred. I think the prices we're seeing are in the range of 90 to 95, a little bit more. PTCs in the later years, if someone wants contracted, probably dip below 90 cents, 85 to 90. I'm very curious to see how prices are going to behave along the fiscal year. So that's to be seen as the market is evolving.
So let's take a step back. And Alfred, you kind of hit on this earlier, and this question is really open for any one of you. So the tax credits are a big deal. But in order to actually earn a good credit, you have to have a good asset that's operating. And just full disclosure for the audience, during our prep session, Alfred, I actually quoted Alfred as saying, we need to develop projects that do what they are supposed to do. What are the risks inherent with that? I mean, obviously, we talked about the recapture risk, and that's out there. But what else do you think about when you just think about the core of these credits and the assets and the importance to them to the marketplace?
I'm happy to start and then would invite others. So in ITC deals, investment tax credits, you're typically seeing risk come from a mix of what the basis of the project is and whether it is later determined by the IRS to be fair market value. And so you will see buyers start to distinguish in their interest in credits when basis goes way up. And typically they're looking for more insurance coverage on those kinds of deals. And in ITC deals, we see insurance at the table in 74% of cases. So it is very prominent that a buyer is looking for it. And again, if you think about the sort of psychographics on a buyer, a tax director, they're again wanting to take zero risk, right? Like they want belt, suspenders, and belt on these transactions. And that means that you're seeing these products start to cover that to take that risk out. The other category of risk obviously has to do with recapture. The last panel talked about weather risk and the risk of the project going out of service. It does step down by 20% per year in a way that is potentially beneficial to the buyer and allows their risk to mitigate as time goes on. And again, often that is indemnified and or insured by the seller.
I mean, this is going to sound a little U.S. Bank pitchy, but I think one of the things that I like about our platform is that we've already committed to these projects before we even show it to a buyer. And so they know that this is a project regardless of whether or not they decide to come into it, that U.S. Bank is going to do it anyway. I think to me that's part of us creating alignment with our buyers. The other thing that I've been, this is more anecdotal, but I've found it to be very interesting, is that a lot of buyers who say they don't have preferences, once you show them the menu of what's out there, will like very quickly sort of latch on to an element of the sponsor or the project itself, and they'll be like, oh no, I actually really like that. Tell me more about this one. I'm like, yeah, you do have preferences. So I do think project specifics and sponsor specifics and sponsor quality will matter to buyers a lot.
Perfect. Uda and Nis, anything to add to that?
I think the education is also a key angle on this, and Eric is selling US Bank, and I'm going to go with CIBC. The players that have been doing, looking at construction risk and operation risk in these projects are key for the education process, along with the other parties around the table. And so the new entrants to the market can take a lot from what we already know in that angle and learn from that and understanding the risks. It's not going to be risk-free, spoiler alert, but we know how to analyze those risks and to quantify them. I think that's the key factor.
Perfect. So on the topic of pricing, loosely, we have a question that came in here. It says, what are your thoughts on how to decrease the barriers to entry for small projects and new technologies in terms of pricing and access to these financial instruments?
Happy to start on that one. So you need to think about both sides with the small projects, right? There's both the newer technologies, smaller developers that are coming to market for the first time, and there are smaller buyers who historically have not participated in the tax equity market, and you need the supply to meet demand. And the uniting thing that will lead that to happen consistently is better education on both sides, but also standardization of terms. It just doesn't make sense to do the level of redlining and negotiation on documents on a deal where the benefit to the buyer may be $100,000, right? So that is absolutely going to be necessary as part of this. The other thing I would observe, back to the new technologies, is when you're in wind, solar, storage, categories that have thought about tax equity for 2 decades, even the smaller developers are sometimes coming out of larger shops. They know how to think about tax monetization. In some of these other categories, like 45X that just got this credit, that may be historical manufacturing companies or mining companies, they don't necessarily have the internal capabilities to do that monetization. They don't have the staff to do it. They haven't thought about it before. So I think with those categories, it's especially important that we invest in education and standardization, make the market easy for them to transact so that people are successful in these transactions.
Uda, I'm going to come to you for this next question. So, I am with an accounting and advisory firm, so I certainly help my clients, but the 4 of you are living this stuff, right? From my perspective, it seems like the transferability rules are helpful to the industry. What are your thoughts? I mean, you're living this day to day. Is this a good thing? Is it a bad thing? How would you sum it up? Where do you think it's going to go in the future? And Eric, I'd ask for you to chime on after Uda gives his initial thoughts here.
Yeah, I think it's a great thing. Like we obviously struggled with understanding a lot of this over the past 1.5 years, but like through the guidance is coming out, I think what we have in front of us is fairly workable between what we got clarity on domestic content, what we had on transferability was fairly well baked. The energy community stuff has always been pretty, well laid out, and you can get to a binary answer. I think in the big picture, challenges remain, right? Like we've talked about transmission, we've talked about it for the last 5-7 years, and from the looks of it, we'll continue to do that, right? There are challenges on just sort of, we talked about how wind projects aren't moving forward as much compared to like solar projects. So like there's definitely some issues in getting that going. Supply chain disruptions that we still sort of haven't recovered from a couple of geopolitical issues, global wars, pandemics, et cetera. So from just sort of overall financeability standpoint, I think what we have is quite workable. We've seen big banks step up. We've seen a lot of innovation come through in the market. It is going to take us a little while. Like I think these hybrid structures are difficult to wrap your head around. It leaves a lot of room for sort of individual judgment and like sort of your expertise and sort of creativity to come in, which is sort of counter to this whole point of like standardizing everything, right? Like on one hand, we're trying to standardize so that there's a level playing field, but leaving room for sort of open-ended stuff allows folks to access markets that might not be that standardized. So we feel very strongly about it. We're all very strongly pushing forward in understanding how transferability and other elements of the IRA fit within our portfolio. And we've sort of, there was a lot of hesitation, resistance in trying to figure out how this is all going to work. But I think now we're at a point where we sort of understand the toolbox that we have in front of us and trying to see what's the most we can do with it.
Eric, Anis, from a lending and banking perspective, what are your thoughts on that?
Yeah, I mean, the IRA and transferability is, a full-throated success. I mean, we did, $700 million in transfers at the end of last year. We're going to do over $2 billion this year, and we're going to do more than that next year. And that's all incremental. Every dollar of that is incremental to what we would have been able to do before the IRA. So, I mean, I think it's brought new challenges that require a lot of hardworking people to collaborate and work together, but it's undoubtedly doing what it was intended to do, and I think that we should applaud that.
Yeah, it's a good thing for the industry.
Completely agree. I think, to probably end or soon in a positive note, in echoing what has been said throughout the day in this panel, it's fantastic to be able to live through the IRA and help the sponsors maximize their capital stack and think about the structures. This has created new problems and new solutions and a lot of lawyer fees and thoughts on structures and how to work with certain problems. But overall, it's been very positive to the renewables, to the U.S. economy in general, I would add, and we look forward to continue to do more in this space.
Udin, I'm going to throw this next question to you here. So from a developer's perspective, are offshore wind projects better off sticking to traditional tax equity or tax credit transfers considering higher risk? So this kind of goes back to the financing question from earlier, but what are your thoughts on that?
Yeah, I think there isn't a choice there. Thinking about traditional tax equity, like based on what you've heard from lending and tax equity here, the previous panel, and all the discussions that we have had in the market, like the traditional tax equity product, as we knew historically and traditionally, is not something that's coming back. It is. I think the more question that's more pertinent now is like, do I do a hybrid sort of a transaction, or do I take a view that that it comes with costs, it comes with governance, sort of considerations, or do I just skip all that and go directly to transferability? So I think that's where a lot of our time gets spent, is sort of figuring out, do I continue to optimize this hybrid box, or do we say, I'm just not going to worry about it, it's too complicated, I'm just going to go find somebody who will just buy this whole thing from me, right? Which for some of the offshore projects, I think we just don't have a choice to pick one or the other. We sort of have to do whatever is out there and do it all, because just the quantum so much.
Got it. And before we wrap up, about a minute left, I'm just going to quickly go down the line. Eric, I'll start with you. Last parting words for the audience from a transferability and a marketplace perspective. Go.
I guess my tweet level review is that transferability, water's warm, like everybody should embrace it, jump on it.
So that's the quote. That's the Finance Forum quote. The water's warm. Go ahead.
Yeah, I'm just repeating myself, but I think the toolbox there at this point, and we just have to continue to figure out how to use it best.
Alfred.
I expect at this conference in 1 year, the transferability panel and the tax equity panel won't be different. These are essentially solving a problem through different mechanisms, and they're fundamentally integrated in a way that I think we're increasingly finding all of the different ways that they can be collaborative to bringing more capital into this market, and that's super constructive.
Anis, you can round this out here.
Not much to add. Looking forward to working together with all of us, and we'll do better and build more renewables in the U.S.
Well, thank you all for your participation and your insights, and thanks everyone for your participation as well.
Thank you.
Thank you, Rob.